Thank you, Darren, for the great introduction. And thank you, Doug, and the Minnesota Chamber for hosting me today. And thank all of you for taking time out of your busy schedules to come and meet with us. I know that you all don't normally live stream your events. I do appreciate you accommodating our request. We think it's very important that we have this discussion publicly. And so thank you for that, your flexibility there. Before I begin, I just want to remind everyone that the views I'm expressing today are my own and not necessarily those of the Federal Open Market Committee or of the Board of Governors, which sets supervision and regulatory policy for the Federal Reserve System. In today's talk, I want to cover two main areas. First, I want to explain why we announced at the Minneapolis Fed, why we announced a major initiative to end too big to fail. I continue to think that the largest banks in America are still too big to fail, and I am skeptical that current efforts to fix the problem will ultimately work. I will then provide a few key examples from my experience during the financial crisis when I ran the Troubled Assets Relief Program, which explain why I am skeptical. Second, I will summarize where our initiative to end too big to fail stands today. We just had our first symposium 2 weeks ago, which focused on two transformational solutions to ending too big to fail. I will summarize key points that I took away from the symposium, and then I will conclude with issues that I continue to wrestle with as we seek the right reform framework to deal with this problem. Then, of course, I would be very happy to take your questions. Now, I come at the too big to fail problem from the perspective of a policymaker who was on the front line responding to the 2008 financial crisis. In the past 6 years, legislators and regulators have worked hard to address the too big to fail problem. My colleagues in the Federal Reserve System have implemented important tools and regulations that are making the financial system stronger under the reform framework that Congress has established. I agree that many of the current reforms are headed in the right direction, particularly those that make banks stronger with additional capital, with deeper liquidity, and with stress testing. But I am not sure those measures go far enough. More importantly, we all know that banks will still get into trouble. So we need a way to deal with failing large banks. The current reforms attempt to address this problem with a new legal framework to resolve failing banks, combined with a plan to bring new investors into banks, those new investors who agree to absorb losses when a bank gets into trouble. The idea is that by having these new investors on the hook, taxpayers will not have to take the hit. Now, this sounds good, but it has not worked in prior crises, and I doubt it will work again in the future. I fear that policymakers will have to turn to taxpayers rather than creditors to impose losses. Now, my experiences from the 2008 crisis highlight this problem. Let me give you a few examples. One of the toughest challenges we faced was dealing with risk spreading between large banks. If you remember 2008, multiple large banks were under stress at the same time, and actions we might have taken to recapitalize one bank by haircutting creditors or counterparties could actually lead to increased stress at other banks as their creditors worried that they too might face losses. In effect, a run at one bank could quickly become a run at multiple banks. This risk is one reason why the Treasury Department asked Congress in 2008 to authorize the TARP, giving the government the ability to inject capital rather than haircut creditors as a means of recapitalization. In fact, if you remember Treasury's announcement on October 13th, 2008, to simultaneously inject capital into 9 of the largest banks in America was done in part to stop the spreading of risk from one bank to another. The challenge of sticking debt holders with losses also occurred with the government-sponsored enterprises, or GSEs, Fannie Mae and Freddie Mac, providing another relevant example of the failure of debt as a loss absorption instrument in a crisis. In 2001, the GSEs began issuing subordinated debt with the specific intention that it would be available to absorb losses if the GSEs ran into trouble. The GSEs compensated investors with higher yields than senior bondholders for the additional risk that they were taking. However, during the 2008 crisis, because of widespread risk in financial markets, Treasury chose to protect the GSE subordinated debt rather than haircut it. The risky economic environment prevented debt that had specifically been issued to absorb losses from being harmed. Instead, taxpayer money again had to be used to recapitalize the GSEs. Let me point to one more example from the crisis about the difference between intentions to impose losses and actual behavior. As many of you probably recall, some large banks had sponsored structured investment vehicles, or SIBs, off-balance sheet entities before the crisis. They had no legal obligation to provide a financial backstop if their SIBs ran into trouble. Yet, during the crisis, some banks chose to rescue their SIBs because reputational risks they would have incurred if they had allowed the SIBs to collapse. The SIBs liabilities became the sponsoring bank's liabilities. During the crisis, reputational risk broke through what had appeared to be a strong legal firewall. So this is the crisis. Perhaps today it is easier to impose losses than it was back then. But a recent case gives me pause. As some of you know, some large European banks have issued contingent convertible debt securities, which are designed to convert into equity if the bank runs into trouble. This debt, however, may actually be a mechanism that spreads uncertainty from one big bank to another. We saw this in recent months as concerns arose that some banks might not have enough capital to be eligible to pay the coupons on their contingent debt securities. Proponents of such contingent debt argue that it will be cheaper for banks to issue this debt than to issue common equity. But given the volatility this debt has experienced in recent months, it is hard to see bond investors not demanding equity-like returns for the additional risk that they are taking. If this debt isn't significantly cheaper than equity as a funding source, the benefits of the additional complexity and unpredictability are not justified. And I have serious concerns that such contingent convertible debt will add to uncertainty in a crisis environment rather than reduce it. At a minimum, our regulatory structures must not make a crisis worse. Our ability to impose losses on creditors of large banks is just as important now as it was prior to the 2008 financial crisis. The recent decision by the Federal Reserve and the FDIC to deem the resolution plans of some of the largest banks in the country not credible suggests that their complexity, their operations, and structures continue to make the potential failure a real challenge for all of us. To me, this means we must work even harder to reduce the likelihood of large bank failures because resolving them in ways that does not trigger widespread economic harm is proving so difficult. So what do I take away from these examples? First, as we analyze the current regulatory framework and other potential solutions to too big to fail, we must attempt to understand whether they would really allow creditors and not the taxpayers to bear losses. Second, we must work to assess whether these plans increase the transmission of risk from one big bank to another. And third, the complex securities and legal protections may not behave as they are expected in a future crisis. If they don't, taxpayers will likely be on the hook. So now let me turn my attention to our recent symposium. Our initiative to end too big to fail includes a series of public policy symposiums that are being held throughout this year. Experts from around the country are helping us examine these issues and are contributing their ideas to help us shape our plan to end too big to fail, which we're going to roll out by the end of the year. Today on our website, we published a summary of the first symposium. And by the way, all presented materials and video recordings of this work are available on our website, minneapolisfed.org. When I gave my initial speech on ending too big to fail in February, I highlighted 3 potential options that experts have offered to address the systemic risk posed by large banks. First, breaking up the large banks. Second, substantially increasing capital requirements. And third, taxing leverage across the financial system. But we also asked experts for other ideas and from the public at large. Experts have pointed us to yet another potential solution, alternative resolution mechanisms that could address some of the perceived shortcomings with the current resolution plans. So we have added this 4th potential option for consideration, and we could potentially add others as we move forward with our initiative. In our first Ending Too Big to Fail Symposium on April 4th, we heard from experts about the need to assess costs and benefits in assessing proposals, and we explored the first two potential solutions, substantially increasing capital requirements and breaking up the large banks. I will now offer you my perspective on these ideas that were addressed at the symposium. So let's start with costs and benefits. Former Federal Reserve Governor Randy Kroszner made a strong case for the need to carefully consider costs and benefits in assessing current and potential future regulatory reforms. He argued we need to consider the costs of new regulation against the benefits of increased safety in our banking system. How much safety do we want? And what price are we willing to pay for that safety? A simple analogy illustrates the trade-offs between increased safety and increased costs, and this is from airport security. Everyone in this room flies at some point. We understand that air travel includes some inherent risk of falling victim to a terrorist attack. The odds are very low, but they're not zero. One cost of safety for all of us is waiting in airport security lines. Now, we could always be safer. For example, if we discarded X-ray machines for our bags and instead had TSA hand search each and every bag individually, no doubt that would make us safer. But what is the cost of this added safety? Instead of waiting 15 minutes or maybe longer at MSP on some days, it might take us an hour to get through airport security if we hand search every bag. Instead of the ticket prices that we're familiar with, routine flights might cost $10 or hundreds of dollars more because TSA has to hire more TSA agents to do that screening. Well, as a society, we have decided that the extra cost of safety provided by hand searching every bag outweigh the benefits. So we don't do it. Now, as the terror threat environment changes, for better or for worse, we might adjust the amount of safety that we choose to pay for, both in terms of time and in terms of money. So preventing banking failures that could trigger widespread economic harm poses similar trade-offs between safety and costs. The benefits of a more resilient financial system are clear. Less frequent and less severe financial crises, resulting in reduced loss of income, reduced lost jobs, lost savings, and lost foreclosures for Main Street. What are the costs? Potentially lower average economic growth between financial crises. For example, increasing the regulatory burdens as a result of Dodd-Frank has forced many banks to hire more compliance officers and more auditors. Requiring banks to issue more equity might increase their average funding costs. These cost increases would have to, at least in part, be passed on to borrowers in terms of higher borrowing costs. Increased borrowing costs for businesses to fund a new factory or for families to fund a home or car purchase could lead to lower economic growth for society. However, we must not only consider the expected growth rates between financial crises. We also have to look at the expected growth rates including the effects of financial crises. An illustration of two simplified economies highlights the choice. One economy has a less regulated financial system and experiences a higher average growth rate between financial crises. But it also experiences more frequent and more severe financial crises than the more regulated, slower growth economy. Depending on the trade-offs, the costs and benefits of various regulations, Main Street might be better off in one economy or potentially the other. I found the discussion of costs and benefits compelling, but as Governor Kroszner noted, we must not suffer from analysis paralysis. Weighing of costs and benefits will be an important part of our plan at the Minneapolis Fed to end too big to fail. Now let me turn to the first alternative. Professor Anat Admati of Stanford presented her recommendation to substantially increase capital requirements for large banks. She noted that before the financial crisis, large banks averaged around 3% shareholder capital. Today, with the implementation of Dodd-Frank and the Basel III standards, large banks have approximately 6% shareholder capital. She made the case that that is far too low and should be closer to 25% shareholder capital, noting that non-banks typically have at least 30% equity funding. The advantages of substantially increased capital requirements are that banks are much better positioned to withstand unknown and perhaps unforeseeable shocks in the future. Increased capital will force banks to internalize the negative externality of the cost to Main Street of another financial crisis. Now, discussants noted that substantially higher capital requirements could lead to higher borrowing costs for businesses and families, which then have the potential to slow economic growth. There was a wide range of views on the magnitude of such effects. Discussants also noted that by substantially increasing the capital requirements of large banks, risks may be encouraged to migrate from the highly regulated banking sector to the unregulated shadow banking sector. For example, if just as many subprime loans had been written leading up to the financial crisis, but rather than being held by large banks, they were held by other highly leveraged financial firms, would the financial system have been any safer? Perhaps not. I found this to be an important consideration as we work to address systemic risk. As I listened to the wide range of views on the merits and costs of higher capital, it struck me that we could increase capital requirements in a straightforward way to address too big to fail. As we saw in my earlier comments about the behavior of legal structures in a crisis, there is a strong argument to be made that simpler solutions are more likely to be effective than complex ones. So I see virtue in focusing on increasing common equity to assets, which seems the simplest and perhaps most powerful in terms of safety and soundness. More capital has another advantage. We have seen extraordinary structural changes in our financial system over the past several decades. We have to be prepared for more change. More capital will absorb losses even from activities we cannot anticipate today. Now, thinking back to my earlier comments about risk spreading between large banks in the 2008 crisis, I realized that capital by itself is not a direct firewall to contain risk. But at a minimum, it does not intensify the spreading of risk from bank to bank. If all of the largest banks had enough capital that investors were confident in their strength, even during an economic shock, such concerns about shared risks could be substantially reduced. We saw this in 2008, as noted earlier, when Treasury injected capital into those 9 large banks simultaneously. Now let me turn to the second alternative. Professor Simon Johnson of MIT and the Peterson Institute presented his recommendation to impose an effective cap on bank size of 2% of GDP, or approximately $350 billion. His proposal is to substantially raise capital requirements above that size if banks exceed that 2% limit. The presenter noted that the failure of Lehman Brothers, which had in excess of $600 billion of assets, triggered widespread damage to financial markets in 2008, while the eventual failure of CIT Group, which had about $80 billion of assets but up to $120 billion in total exposure, that did not. Now, the presenter argued that having large banks at the center of our U.S. financial system is a fairly recent phenomenon, taking off in the past couple of decades. And yet he argued that economic growth was very strong in the U.S. in the decades before banks became so large and so concentrated. He argued that there is very little evidence that the recent large growth of banks has led to real economic benefits for the U.S. economy. I have to tell you, I had not heard this argument before the symposium, and I found it compelling. Discussants appropriately noted that simply having numerous smaller banks is not necessarily less risky than having one large bank. It depends on the underlying risk that each bank takes. For example, if a $3 trillion bank, and we have some of those in our economy, if a $3 trillion bank were to break into 10 $300 billion banks, and each of those new banks made identical investments, there is little enhancement to financial stability. Because if a shock were to hit the economy that imposed large losses on that original $3 trillion bank, the 10 smaller banks would simply share the identical losses, each coming under similar distress. I believe this argument, while logically true, must be tempered. It is unlikely that 10 smaller banks, each with its own management team, each with its own board of directors, would all make identical investment decisions to one another and to the original consolidated bank, long into the future. To the extent that their business strategies differed from one another, financial stability should be enhanced. Discussants also expressed doubts about how easy it would be to actually implement a breakup plan if it were enacted. An image of government analysts arbitrarily deciding how to divide $1 trillion bank into smaller pieces, deciding, for example, which branches and which operations go with which new entity, gives many people concern, including me. But the presenter noted that rather than having the government decide how to divide large banks, incentives should be put in place such that banks decide for themselves how to optimally divide to meet the new regulatory cap. In fact, the new requirements already put in place after the financial crisis have encouraged some large financial institutions to shed some operations and some assets. While the magnitude and speed of their spin-offs may not satisfy financial stability concerns, they do demonstrate firms' ability to downsize in response to new requirements. I believe that given sufficient incentives, banks would be able to restructure themselves. Discussants presented analysis that large banks benefit the economy by providing economies of scale. While there is a wide range of estimates of such benefits, they should lead to lower operating costs compared to relatively smaller banks. I believe these scale arguments need to be thought of in the benefit and cost framework that I mentioned before, as banks with scale may also pose significant risk to financial stability, so there are costs too. But accepting this analysis at face value, I worry that Dodd-Frank is adding to the advantage large banks have over small banks, given that complying with regulatory costs likely exhibits scale economies. We need a regulatory system that does not add to the advantage large banks have over small banks. So reflecting on our first symposium, I am left with some important questions for further consideration. Should we view these proposals to address too big to fail in isolation? Or could we combine them? How do the costs and benefits of proposed solutions line up relative to the status quo? How much confidence do we have that solutions will perform as expected in a crisis environment? Will markets think that the proposals credibly put creditors at risk of loss? Will the solutions merely push risk into unregulated areas of financial markets? Will the solutions promote fairness between the regulatory burdens on large, small, and medium-sized banks? How likely are the solutions to remain effective over decades? The Minneapolis Fed's initiative to end too big to fail is still at its early stages. Our next symposium is scheduled for May 16th, where we will hear from Professor John Cochran of the Hoover Institution, who will present his plan to tax leverage across the financial system as a means of reducing systemic risk. We will also hear from John Bavenzi of the Bipartisan Policy Center and Oliver Wyman, who will present an alternative resolution mechanism. We will once again hear from a group of experts who will bring a wide range of experiences and perspectives to respond to those proposals and offer their own ideas. Like the first one, and like today, all of our symposiums will be open to the press and live streamed so that we can inform the public while we learn ourselves. We believe engaging the public in an open and transparent process is an important part of building confidence in our regulatory system. Thank you very much for your attention. With that, I would be very happy to take your questions.
So we want to welcome some questions from the audience. This is your chance to ask questions of Mr. Kashkari. We'll walk around and look for someone that looks like they're interested in asking a question.
Up here in front.
Well, Bob, I won't introduce you. You can do the honors.
Thanks. Last week, Jamie Dimon wrote an essay that was published to answer the suggestion that big banks should be broken up. And his argument, though eloquent, I thought was not particularly compelling. But if I can paraphrase it, he said large multinational corporations need to be financed by large banks. And if the United States doesn't have them, somebody else will. So it's good for the United States to have large banks, and they shouldn't be broken up. How would you respond to Mr. Diamond?
Well, first of all, I read that part of his shareholder letter. I particularly enjoy the conclusion where the ultimate scare tactic, he invoked the Chinese. He said, if we break up our banks, the Chinese are going to come and take over. That's almost like waving the white flag. I don't find the argument compelling. Here's the thing. Two things. Number one, large multinational American companies manage thousands of suppliers all around the world. You mean they can't manage a few dozen banking relationships? Of course they can. And I've talked to CFOs at some very large companies that have acknowledged this fact. Number one. Number two, I agree too big to fail is a global issue. It's not just American banks who are too big to fail. There's some very large European banks and Asian banks, for example. We have to focus on what we can control. If we could enact laws globally, that would be my preference. But we can't just unilaterally do that globally. So my view is we should start here at home, advocate for policies that make sense for the U.S. economy. One level playing field. Any bank that wants to do business in America needs to abide by our rules. And if we show that we can do this, then perhaps we can lead the world and encourage other countries to follow our lead. Thank you for the question.
Neel, I hope you would agree that in a free enterprise capitalistic system, arbitrarily breaking up the big banks is a fairly radical proposal. Is this to say that regulation has failed? That it's no longer the solution for managing these institutions? And if so, didn't the Federal Reserve have a large role in the regulation of these institutions, and wouldn't they own some of that problem?
Sure. Well, I think, first of all, let's start with the second part of your question. If you look at the causes of the financial crisis, almost every part of society had some role to play, whether it's homeowners, it's investors, it's regulators, legislators, rating agencies. I think we all contributed to the problem. What I'm saying is that we cannot hope that our regulators of the future are omniscient. It's very hard to predict financial crises. You know, if we really saw these things coming, we would take actions to protect ourselves. And I'll give you an example. How many people in the room actually predicted the price of oil would go from 150 to 30? I don't know anybody, right? And supposedly we're all on alert for financial shocks. That's a big financial shock. It's a good shock for drivers. It's a bad shock for oil producers. But very few people saw that coming. And so we have to assume that regulators of the future are not going to see the shock coming. And so how do we design a financial system that can take that shock and not impose widespread damage to the economy? So think about Silicon Valley in the 90s. Remember, we had the huge tech boom, and then we had the crash in 2000, 2001. That was very painful for Silicon Valley. I don't think regulators should have done anything to prevent that. Markets made mistakes, that's okay. But it didn't crash the whole U.S. economy. The difference in our financial system is if our financial system makes a mistake on that order, it's like our economy has a heart attack, and that kills the patient. It's not just a flesh wound. And so that's why I think we need to consider transformational solutions. Now, we haven't drawn any conclusions about what the right solution is yet, but we need to have the honest conversation with the American people about what risks we're still facing and what some of the solutions could be.
We have a question over here now. Aaron, can you introduce yourself too?
Erin Procco with Bell State Bank and Trust. My question is, you spoke a lot about increasing capital for bigger banks, but what would a major change in bank capital requirements mean for mid-size or community banks, knowing that a lot of businesses rely on funding from those sources just as much as the bigger banks? And then also, what's the regulatory future for those size institutions?
Well, I know across the Federal Reserve System, we've got the message loud and clear from small and mid-sized banks that many are struggling under the new regulatory frameworks that have been established. And I think they're caught in the same regulatory net. While Dodd-Frank is trying to really address too big to fail, but it ends up layering a lot of regulations on everybody else. And that's putting small and mid-sized banks at a real disadvantage. And so my hope is that if we can get confident that we have the right solution for too big to fail, and we come up with the right solution and we address that, then perhaps we can relax some of the burdens on small and mid-sized banks because they're not there's no risk that they're going to bring down the whole U.S. economy. And so right now, I think that these issues are interwoven, but we need to really address too big to fail so that small and mid-sized banks can do what they need to do in our community. So I'm guessing my answer is agreeing with the spirit of your question, and I think it is a big problem. But I struggle to see us relaxing the pressure on small and mid-sized banks until we as a country are confident that we've dealt with the biggest banks. I think the two things have gotten wrapped together. Okay.
Hello, and thank you so much for being here today. You've talked a lot about banking regulations, but I'm kind of curious what your thoughts are, or if you have any comments on the strength of the dollar. A lot of us sell our products internationally, and we're working in a global marketplace, and I think that the strength of the dollar is something that's important, and it definitely impacts our business.
Yeah, well, so first I'll say, I used to work at the U.S. Treasury Department, and it's pounded into us when you're at Treasury that only the Treasury Secretary comments on the dollar. So let me start with that. I think that's still true today. I will say that as I travel around the 9th District, so the 9th District of the Federal Reserve District includes Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin. We have a very diverse economy, but a lot of, in the sense of almost every sector of the U.S. economy is represented here. But many of those sectors are export sectors or are competing in global markets. So our commodities, our ag sectors, for example, are exporters. And so when I travel around the 9th District, I hear it over and over and over again about the challenges that the dollar is placing on businesses and producers here. And so we get that loud and clear. And it is certainly one factor that goes into the analysis of the future outlook of the U.S. economy. So the Federal Reserve's day job, so to speak, is monetary policy. And next week, we're going to be getting together for the FOMC meeting and looking at where have global currencies gone. That is an input into our analysis as we think about the optimal course for monetary policy. So I'm with you. You know, we hear it loud and clear. It's not something that we directly try to target, but it is an important input as we think about where the U.S. economy is headed.
Back here.
Thank you. David Allers with Graco. Neel, appreciate your remarks today. I'm with a company that makes nearly all of its products right here in Minnesota, and yet half of what we sell, billion-dollar company, half of what we sell outside the United States. So we need global financing. If you break up the big domestic banks, where will businesses like ours turn for international financing?
Well, I think, again, just to repeat, you know, we haven't drawn any conclusions about what the solution is, whether it's break up or more capital. You can imagine in a scenario where the largest banks simply had more capital, they may still have global operations as well. And so that's one of the factors that we're going to look at as we talk to large companies that big banks serve to understand how do we make sure that they are still able to meet their needs. But again, I go back to my earlier comment. You're exporting all around the world. You're producing all of your products here. My guess is you have suppliers and you're able to manage those suppliers. My guess is that large companies are able to manage suppliers around the world, and you probably aren't just working with one bank. And so if you ended up, I'm just making this up, let's say you end up working with a couple banks, and one of those big banks has operations here in Europe, and another bank has operations in Europe and Asia. Does it really have to be just one bank you're dealing with, or could you stitch together the number of banks that would serve your needs? I'm not suggesting, by the way, that there are no costs to any of this. The question is, are we as a country better off making it more convenient for you, but where the whole economy is vulnerable to massive financial crises? That's the trade-off. I'm not suggesting that there won't be any cost at all. There will be some costs. But if the cost is every 50 years or every 100 years, we have this traumatic systemic event where people all across the country are harmed with lost jobs and foreclosures and lost savings, and there's literally an economic heart attack, that's a pretty big price to pay for your convenience. And I know you're not suggesting that. I don't mean to pick on you, but I'm trying to highlight the choices and some of the trade-offs that we have to wrestle with. Thanks for your question.
Neel, back here.
I'm Russ Swanson, Chief Investment Officer at Thrivent. Earlier you mentioned the GSEs, Fannie Mae and Freddie Mac. And as you know, they received more financial support, bailout money than the banks did. I'm wondering what you think should be done with them. Do you think it'll happen, and what influence the Fed has on that?
You know, I don't think the Fed has much influence. This is really pure fiscal policy so in 2008, the Treasury Department, and I worked there at the time, put the GSEs into conservatorship, which is basically a holding status where the government took them over to try to make sure that they were safe. And the U.S. Treasury put a few $100 billion in to absorb the losses that they faced. Well, they're still in that limbo. They're still kind of in this holding pattern. It was meant to be a temporary status until Congress and the executive branch decided what to do with it. Well, so far there's no action by Congress or the executive branch, so they're just stuck in this holding pattern. You're right, something needs to be done. And there are a number of options that experts have proposed. Everything from winding them down on one end to fully nationalizing them on the other end to turning them into, for example, something like FHA, which is a narrower business model. Ultimately, that's for Congress to decide, but I'm with you in the general thrust that we do need to come up with a solution. It does need to be implemented so that we're not in this limbo status anymore. You know, whether there's actual political will to make those choices, I don't know. And I don't think the Fed has much influence on that. If people ask us for analysis help, I'm sure we're going to be happy to give it. But we do try to stay out of the business of direct, lobbying Congress on specific fiscal policy.
Over here.
Hi, I'm Michelle Engdahl from Thomson Reuters, and I also serve on the board of the Chamber. Thank you for being here.
Thank you.
So the largest banks employ thousands of people here in Minnesota. How would increasing their capital requirements change how they operate here? Specifically, how many they would employ? How would it change that number? And what kind of skill set that employee would need?
Sure. That's a good question. I don't know yet what it would change to the employment by the largest banks in the Twin Cities. You could imagine if you have to raise capital requirements, there are a couple of ways of doing that. One is you go out to the markets and you raise more equity to increase your capital position. Your return on equity would probably go down. That's why banks have so little capital, because it boosts their returns. Their shareholders like that. So the question becomes, are the banks, what does their profitability look like at these higher capital positions? My guess is the largest banks in the Twin Cities would have an easier time meeting those new capital requirements than some other of the large banks where they're already trading at below book value, as an example. And so I think investors would question their business models. The other way of meeting the capital requirements would be to reduce their assets. You keep the capital base the same, but you reduce assets, you spin off certain operations. And so it's unclear how the banks would choose to respond to themselves. But I'll tell you this, if we had large banks in America that had a lot more capital, they would be a lot less volatile during financial cycles. And so if a financial crisis hits the Twin Cities and we have large banks here that are not very well capitalized, a lot of their jobs are going to be put at risk. If that same crisis were to hit and our banks had more capital, those jobs would be safer. And so, again, this is core to the cost-benefit work that we're trying to do right now to assess the right path. Thank you.
Neel, I understand the focus on too big to fail, but what about the shadow banking focus and the real culprits of the last go-around, Countrywide, AIG, Lehman Brothers, to name just a few? What's that focus about?
Yeah, that's a big part of this, and we have to look at the shadow banking. And, there's something a week or two ago happened that's actually very important. So Dodd-Frank, the law that Congress passed, that the president signed, gave the Fed and the Treasury Secretary the ability to designate non-banks, like AIG, as systemically important. Well, MetLife, the big insurance company, sued the government, took them to court. They didn't like it. And they went to court, and this judge sided with them. And so now this process is uncertain at the moment what it's going to look like. But the truth is, what we call a bank or an insurance company, whether we call it too big to fail, that's not what determines whether or not it's too big to fail. Its activities determine whether or not it's too big to fail. It's like this. If you go to your doctor and your doctor diagnoses your disease and you get really mad at your doctor for diagnosing your disease, that doesn't change whether you're healthy or not, right? If you've got the disease, you've got the disease, whether or not your doctor goes along with what you're telling him. That's basically what MetLife just did. They didn't like the diagnosis, so they sued. They got a judge to side with them, and now they say, look, we're not systemic anymore because some judge went their way. That doesn't change the risk they pose to the U.S. economy. And so if this means that Congress needs to go back to toughen the law to give regulators the tools they need to deal with AIGs, to deal with the MetLifes, to deal with the shadow banks, then maybe that's what we need to do. But this is something that we are looking at as we are working to end too big to fail. It's not just about banks. It's also about some big non-banks. All right. Thank you all very much. I really appreciate it.